Hello. Marc, what's up, man? Good to see you.
Great to be here with you, Mike.
All right. Welcome, everybody, to another episode of Talking Wealth. My name is Michael Batnick, and I am so excited to be joined by Marc today. All right, here's what we're going to be talking about. Secondaries. They used to be a niche corner of private markets, a way for institutions to quietly offload old fund positions, but today, they're becoming a core feature of modern finance. In this conversation, Marc and I will dig into the rapid rise of secondaries, why private assets are staying private for longer, how liquidity is being engineered rather than waited for, and what this shift means for valuations, incentives, and risk. We explore who wins, who loses, and whether secondaries are making private markets more efficient or just more complex. But first, a word from our sponsor. Today's show is sponsored by YCharts. If you're a financial advisor, you already know the hardest part of the job isn't finding data, it's turning that data into clear, confident conversations clients actually understand. YCharts help advisors research faster, visualize market data clearly, and turn complex portfolio questions into client-ready insights. On average, advisors using YCharts save around 20 hours a month across research, proposals, and client prep. And now, with built-in AI tools, advisors can quickly surface key takeaways, understand what changed and why, and spend less time digging through data. Whether you're comparing portfolios, stress testing strategies, or answering tough client questions in real time, YCharts helps cut through the noise and keep your clients focused on what matters most. Learn more at ycharts.com or click the link in the show notes to start a free trial and get 20% off your initial YCharts professional subscription. That is for new customers only. Okay, Marc, you wrote a piece. So first of all, if you are at all interested in the intersection of wealth tech and asset management and private markets, Marc is the guy. I look forward to his Substack, which is, are you publishing, is it like every other week? How often are you writing?
Every week, typically on a Friday.
Okay, you're a busy man. So every week I learn something new. And today, or last post that you did, I read something that I was like, man, you know when you read something and it's like so obvious, you're like, I'm sort of mad that I didn't have that idea. Let me quote you back to yourself, and we could get your take on your take. All right. In a world that's speeding up, private equity stands out as an anachronism. Over the past half century, holding periods of stocks have collapsed from over 5 years to under one. CEO tenures have halved. The average lifespan of an S&P 500 company has fallen from 6 decades to under 20 years. Yet private equity still asks investors to lock up capital for 12. Like, what a great and obvious point. And I apologize, Marc. I should have given you a proper intro. But I don't want to assume that the rest of the audience is as familiar with your work as I am. Just a quick background. Why are we talking to you?
So I write a weekly newsletter called Net Interest. I've got 25 years of experience as an analyst and then as an investor in the financial services sector globally. And so I bring some of that expertise through the newsletter to the wider public. I've now got close to 100,000 subscribers, and it's just great fun learning and sharing that with the membership.
Okay, so back to your quote, the world is speeding up, and yet there are many funds that you described in your post that are still holding like literally investments from like 2006 or whatever. Right. It seems wild. And this is very much what you write about, which is like enter the wealth channel, right? The institutional investors, they're full, they're allocated 30, 40%, even higher in some cases. Like the money coming back to them has not been what they would have hoped. And so let's find more money. I'm not saying it's not as nefarious as it sounds. Okay. But like, okay, with the wealth channel, we have no money invested. It rounds to zero. And it's a great opportunity, democratization, all that sort of jazz. And in 2022, 23, I started to feel like there was a bubble in my inbox for private credit. It's like, hey, I've sort of heard of private credit, but like, this is relentless. Like, why am I getting 4 emails a day? And now it's secondaries. So, okay, getting back to the opening paragraph that I just read, what is going on inside the world of private equity, and what role are secondaries playing?
Well, it kind of feels like the world is bifurcating. On the one hand, you've got public markets where velocity is increasing, holding periods are shrinking. We've got, you've spoken about it before, option activity is ballooning, and that is a big trend in the public markets. The flip side is you've got the private markets, which are growing, which are inherently illiquid. Companies are putting off IPOs. There's some speculation we'll get some big IPOs this year in 2026, but they are sitting in private markets for longer, these companies. And there's a kind of a paradox there. On the one hand, all of us are getting less patient. We all want an outcome, whether it's in financial services or in retail or in gaming. We kind of want an outcome. We want immediate feedback. And yet we're still happy, or maybe we're not, to hold on to private stakes for 12 years plus. And I think the answer is we're not, hence this solution.
So secondaries are not new. It's not like all of a sudden, oh shit, I can't get out of my investment that I've been for 11 years. It's appreciated. Let me seek some liquidity. Like the volume, that's different. But can you just rewind a little bit and talk about like just the idea of a secondary? I don't want to take for granted that people understand what it is. Like, what even is a secondary transaction?
Right. So traditionally, the private equity model required the investor, the limited partner, to tie their money up for a long period of time. Money would be drawn down in phases over 4 or 5 years, and the investor would get some kind of cash return, maybe 6, 7 years out, with the final cash returns coming through 10, typically 10, often that could be extended 11 or 12 years out. Very, very long-term commitment. Historically, there was a small market for investors who 3 years in, 4 years in, decided they could no longer fund those commitments or wanted some liquidity to sell their positions in those private equity funds to others. From the manager's perspective, it was a bit of a nuisance. The manager, and so typically the investor would go through an intermediary and find a buyer. Often, so, but this was a small market. It was a peripheral market. Demand on the sell side increased in the financial crisis. As you can imagine, there was a demand for liquidity then. People didn't want these liquid assets anymore, but the buyers weren't there to the same degree. So all the way through, the market began in 1979. That was the very first transaction. But all the way through until about 2010, it was tiny. It was a peripheral, tiny market. And then mid-2010s, it started to balloon. And recently, it's gone exponential. There are various reasons why it's gone exponential more recently, linked to even less liquidity for the investors in these funds.
So Blackstone reported last week, and Jonathan Gray, the COO and president, said, our secondaries platform saw a record year of deployment in 2025, and we see strong growth ahead, fueled by the ongoing expansion of private markets. They've got they raised $19.5 billion into secondaries last year, which is like a third of the money that they raised in private equity total. So this is, it's bigger than infrastructure, which is like data centers, and that's like a super hot area. Like it's a lot of money. Now, from the investor's point of view into the secondaries, I get the story. It's like, hey, wait a minute. I have more clarity into what's in the underlying, right? I'm like, it's not like we're calling down money, we're making new investments. And in many cases, all cases, correct me if I'm wrong, we're buying at a discount, and I'm using air quotes because it's a discount to whatever they're marking it at. And ostensibly, you're closer to liquidity, right? If you've held this in the portfolio for 8 years, the original investors, I'm guessing, have a markup on that, then it makes sense from the seller's point of view to get some liquidity, and it can make sense for the buyer's point of view. It can be a win-win. So it's not, I don't want to make it sound as if there's like anything shady happening here. However, I don't know the mechanics of how this works. Part of the things that can appear shady is, hey, wait a minute. If it's the same sponsor that's buying and selling, like not robbing Peter to pay Paul per se, but company XYZ has a secondary fund and they're buying a piece of a previous investment. How frequently does that happen? Is is that not a clear conflict? Maybe it's not. I'm not sure how to think about it.
So we are seeing more of that. So as I said before, traditionally the market was driven by end investors. And the end investors wanted to generate some liquidity in their holdings, and they looked for a buyer to take on their stake. And the manager was not involved at all.
So it was supply side. So the existing LPs are saying, we'd love some liquidity. Hey, this position has done really well. Find some demand for us. And maybe just more on that, like what does get sold inside? What does so there's an existing fund, it's in year 9. Like, is it like the best holdings that are sold because that's where they can get the most liquidity? Or is it like, hey, this is an underperformer, let's just get what we can get? Like, talk through that dynamic, because I'm totally...
It's a really good question, because that's also what's changed. So again, going back 15 years, there was a kind of adverse selection there. Either the seller was a distressed seller, they needed the cash, or the underlying asset was a little bit distressed. It was an older vintage that the investor, the limited partner, just wanted to get shot of. More recently, it's become a tool. So more recently, it is, well, we'll talk about the demand side in a sec, but similarly on the supply side, there is a reason why firms with large allocations to private equity want to portfolio manage that. So the example I gave in the piece that you highlighted up front was Washington State Investment Board. Really interesting pension fund. They were one of the first, along with Oregon, into private equity back in the 1980s. Their first private equity play was a KKR fund back in 1982, I think it was. They've been allocating to private equity ever since for 50 years, and they're now at 28% of their portfolio. Now, the state treasurer has come along and said, 28% is a little bit too high. We might want to rebalance that. So there's a reason why they might become a seller. Similarly, Yale, big announcement last year, kind of summer of 2025, that Yale was selling a large part of its private equity portfolio. Various reasons for that, linked to pressures on their kind of underlying business, the university business, but also a new CIO came in after David Swenson, who was the pioneer for this model. A new CIO came in, Matt Mendelsohn, and as in any firm, when a new CIO comes in, he might not want to inherit the portfolio of his predecessor. So there are reasons, not just linked to distress, why investors, why sellers might want to tap this market. Historically, they'd been a bit constrained because the market wasn't big enough. But like all growth markets, supply feeds demand, demand feeds supply, and that's what's been happening here.
Let me ask you a very general question. Would you personally invest in a secondaries fund?
Yeah, I think I would. Full disclosure, I have. And I think, and you kind of hit on it, the advantages over traditional primary private equity is that you can from day one, you can lay out a lot of capital. Not a lot. You can lay out without funding commitments over several years.
Which is annoying.
You can have it all in the market on day one. You can get a more diversified exposure because you are allocating to a number of different managers, number of different vintages. You've got better transparency. It's kind of a blind pool from the primary market. You are entrusting Blackstone, who have built up a reputation, but you're entrusting them to go out and find the deals. Through the secondary market, you can see the deals, and you're getting a bit of a discount, and the cash flows are coming back to you more quickly. So the overall return on capital might be the same, but you're going to get cash flow more quickly.
So I think I agree with you. I would rather be in the position of being the secondary buyer, but there's all sorts of things that you have to be aware of. So for example, we'll talk about the amount of money coming into it, which guess what? We know what that does. It compresses the discount. All right, great. The average discount used to be 15%. And also, discount to what? These are not like liquid investments. A discount to whatever the seller says it's worth and the buyer agrees. All right, whatever. But like maybe on the nefarious side, and if it's disclosed, it's disclosed, but I think this is kind of yucky behavior. What if you buy something at a discount, the prevailing market price? Now, you might say it's a discount, but whatever. You paid 80 cents, okay, and then you immediately mark it up and then charge fees on the marked up version. Is that, I mean, that's sort of more common than not, no? And is that like cool? Are you cool? Would you be comfortable with that as an investor?
Yeah, it's a good point. It happens, right? I guess one of the downsides of this asset class, primary or secondary, is one is the fee drag, which you've highlighted, and two is, even though you have slightly more transparency in the secondary market and the primary market in terms of underlying assets, you still don't have the transparency you have in public markets on the valuation of those assets. And there's a lot of dispersion between what managers, what firms do, how they mark these assets to market. And there have been many examples where the same asset is owned by two different firms and they're marking it at different valuations.
Yeah.
Very little transparency.
I mean, listen, if you buy something for 88 cents on the dollar and you want to mark it up to $1, I could see that. If you buy something for 40 cents, guess what, buddy? It's not worth $1.
Right.
All right. So you mentioned earlier, like the rise of private markets. Yeah, listen, I get it. Like, it's awesome. Give me. I'd even pay a liquidity premium. Forget about the discount. If you're telling me you can get equity-like returns, and with private equity, a little bit of leverage, you can get better. And yeah, listen, the businesses are as volatile as the publicly traded businesses. We're not complete idiots, but you don't have to look at the price on the NASDAQ every day. Okay, lie to me. I like it. That feels good. Yeah. The problem is, or one of the potential problems is, public markets are not being kind to a lot of the companies that were previously private. And there are plenty of examples of companies that were trading for X, and then, hey, liquidity, and it's like, hey, it's actually 60% of X. This doesn't feel very good.
Yeah. No, it's a really good point. There's tons of examples. I was looking, so I look more.
There are tons of examples.
The class of 2021, when there was a lot of IPOs, many of them, Robinhood is the standout, was a very good performer, but many of them underwater. Class of 2020.
Mark, we could say 2021 was an anomaly. Listen, a lot of sloppy behavior, public and private. I would say, okay, whatever. We were all a little bit drunk. But even more recently, companies that have come, and like real companies that have come public in 25 and 24, like, not great.
Yeah, it used to be, I think Warren Buffett, various other phenomenally successful investors said they would never touch an IPO because there's a reason why the seller is coming to the market at that point in time. Now, It's a bit cynical because kind of the topic we're talking about here is they have their own investors who demand liquidity. So that can be the reason. But we are dealing with, who's on the other side of the table here? These are the most sophisticated, these private equity guys, they're the most sophisticated financial engineers on the planet. And when they come to you and try and sell you something, you need to ask the question.
They have more information than you do.
Right.
There's a really fascinating story in public and private markets today. We're recording this in early February of 2026. Software names are trading like they're going out of business. And I have no opinion on whether or not they will. Like, that's really my bag. But it's fascinating to watch the market behavior. And one of the areas that private investors were feasting on are the SaaS businesses, because these entrenched models, they were bond-like, and they had the equity kicker of like growth, right? It's like we have very predictable cash flows. We've got whatever, 2% churn, whatever it is. Like, we can model this out.
Yeah.
And then all of a sudden, overnight seemingly, all of that is coming into question. And you're seeing the large asset managers, Blackstone is getting smoked today, near 52-week low. And by the way, putting up phenomenal numbers. Like, the business is on fire. Blackstone's business is on fire. But public investors are saying, I don't want the stock. not specific to Blackstone, but all of these companies. And if you look at the even worse, the publicly traded BDCs that are making loans, I think I saw somebody post like Ares, one of Ares' portfolios is 23% software. I don't know if that was industry average, but it's quite literally, it's the biggest industry group in many cases. Oof. Not really a question, but what are your thoughts?
So I was thinking, so absolutely, I was looking at some numbers just before we came on air. Since 2014, software has accounted for close to $1 trillion. The software industry has accounted for close to $1 trillion of buyout activity. And so if we look at buyout funds exposure to software, it's about 11%. It's about 11%. So there are some outliers. On the credit side, the exposure is higher than that because over the past various number of years, software has become much more active on the credit side for the reasons you've said. The cash flows were stable enough to be able to sustain higher debt loads than was the case historically. So they've been very active there in private credit markets. And so some of the BDCs which specialize in private credit, you mentioned 123% plus, they will have exposure more than 11%. And this is what happened. BDCs are interesting in the broader context of what we're talking about because there's a kind of a mismatch there. They, on the one hand, invest in private assets, but on the other hand, their equity is public. So the market is valuing, without having full disclosure of their portfolio, the market's valuing their assets on a daily basis. Companies themselves are valuing on a monthly, quarterly basis.
I'm sure you were all over the Blue Rock story.
Right.
The conversion to a BDC. Oh.
Right. Yeah. Oof. Yeah.
So
a 19%. That was a 19% markdown. Is that right? That's the one?
I think it was worse, dude. I think it was like 30 or 40 on day one.
Okay.
Yeah, there is. I don't want to. I know I'm painting it in a negative light, like whatever. I think I have a lot of concerns. I don't think it's all bullshit. I think would I invest in a secondaries fund? I would consider it, but I would certainly have a lot of questions. Let me put it to you this way: you've invested in secondary funds before, not to give us like 20 due diligence questions, but like at a high level. What should, if advisors are listening and they want to do some basic like how to get smart? What are some questions that you should be asking the GP?
So I'll come on to that. But you make a really good point about the benefit of illiquidity, which is if people talk about there's a great line about buying Amazon at the IPO. If you'd have bought $1,000 in Amazon at the IPO, how rich would you be now?
Yeah, you would have sold it 100 times.
Precisely. You would. So you're making the point now about these software companies. I don't know. Are they all going out of business?
Probably not.
Probably not.
Yeah.
Does a public investor have the wherewithal to go into the market and buy them today? I don't know. But if you're locked away in a private fund and you're not having to make that decision, then 3 times out of 4, 5 times out of, there's going to be some non-trivial percentage that is the right thing to do, to hold on and be saved from yourself. So there is that advantage, and I don't think we should trivialize it.
There is the principal agent problem, which is obviously not new. It's like, listen, these are very smart investors, okay?
Yeah.
Blackstone, Ares, whoever, like these are not dumb people. They know what they're doing. They're highly trained, professional, legitimate investors. And also they have a job and a career and families at home. Again, not a question, just a statement.
Yeah, Apollo, actually, of them all, Apollo is a really interesting one. Back in October of last year, so some of these software stocks, you're right, they are having a bloodbath this week, early February 2026. But many of them have been, when I look at companies in the kind of market intelligence space, companies like FactSet, companies like S&P.
Brutal.
Right, brutal. But that brutality began kind of October last year, but it wasn't really perceived as being an AI risk in October last year. Apollo, the head of credit at Apollo, he stood up in a conference and he was asked kind of biggest risks. People were still worried about tariffs back then. People were worried about a whole host of issues back then. And he said, actually, software allocation within private funds is a risk. So it's maybe you don't want to be sitting on the other side of the table of these guys, but listening to what they say, tracking what they do, can be a profitable strategy.
I listened to the earnings calls from not all these companies, but a lot of them.
Yeah.
So I think you learn a lot just listening to somebody's voice and their right.
Yeah.
The contrast between Marc Lipschultz, this was last quarter, or I think last quarter, between what he was saying on the call versus what Mark Rowan was saying on the call. I say, you know what? I want to give money to Mark Rowan because Lipschultz is being super defensive, saying the market doesn't understand, taking it personal, which believe me, I get it. This is business. And Mark Rowan is just calling it like it is, calling balls and strikes. Like, listen, yeah, was last year a better time to invest in these companies, company XYZ? Yeah. Was it a better time to invest in NVIDIA a year ago? Yeah. Let's be grown-ups about this situation and call balls and strikes. And so I think the end investor has to be discerning about who they're giving money to. But on the advisor side of the table, how? Right? It's hard. What do we do?
So that comes back to the questions I would ask, a GP. I think secondaries is an interesting market because there is an advantage to information. Like any new market, information has an advantage that ultimately gets arbitraged away. And there's not that much information in this market. Information, it's disseminated asymmetrically. We've talked about some of the differences in valuation of underlying assets. But if you've got the scale and the knowledge through also running a primary business, then so there's been a few trades in this space. EQT, there are 5 big players in the secondary space. The first is a European firm, and then you've got Lexington, which is owned by Franklin. Mm-hmm. You've got Franklin Templeton. You've got Goldman Sachs. You have got you've got a couple of others, but one of the earliest secondaries companies, Collar Capital, European based, just been bought by EQT, one of the big primary private equity firms based out of Stockholm. I think what that indicates is that increasingly secondaries sit alongside primaries, and the firm that has the knowledge of what's going on in the primary market is able to underwrite secondaries to a better degree. So we're seeing a lot of that. I think the benefits of scale through that information access is useful. And then also scale in terms of being able to do the biggest deals. So when New York pension fund put $5 billion plus on the market last year, very few secondaries funds could bid for it. I think, was it Lexington that won that? I can't remember who won that one. And then similarly, when Yale put its portfolio on the market, there were very few, it's kind of the same names that were in the running to buy that stake. So there are some advantages in scale, which is what we're seeing. We've seen that in passive on the public side. We've seen that in on the primary side with Blackstone, and we're seeing it on the secondary side as well.
Sorry, finish your thought.
No, I think those are the things. I think scale, I think information and the information systems, the underlying systems that the firm operates, clearly track record. Actually, what both Lexington and Goldman have disclosed is that last year they only completed on 3% of what they looked at. That's an interesting data point. How much are you seeing? To what degree are you in the flow? And then how much are you diligencing? And then how much are you actually completing on?
So if that's true, as an investor, obviously that's a great number, right? That's like, okay, they're being very discerning. Last question, not to make things even more complicated than they already are. I think the tenor of this conversation has been about secondaries and private equity backed companies. There's also the venture side of it.
Yeah.
Right. I can't remember who Goldman bought recently, but they made a large acquisition because there's even less liquidity. I guess I guess I'm making that up in the venture space. Like companies that have done like the Series F and G and whatever. Like investors want some liquidity there, and I totally get that.
Yeah. Yeah. No, that is right. Yeah, sorry, I forgot the name as well. Inside Ventures. Yeah, they bought that thing. No, that is absolutely right. And equally, and again, kind of a market, when new asset classes form, it needs, like any market, any two-sided market, you need the buyers and the sellers. The sellers, as you said, are eager to generate some liquidity, and the buyers, demand for SpaceX and the demand for some of the innovations being launched by Robinhood and others to tokenize private companies, very high, right?
Dude, so, it seems nuts. I can't. And maybe that's another topic for another day. I can't believe. Again, these are smart people, so they have more information than I do. But some of the numbers that we're seeing just sound totally Looney Tunes.
On what, SpaceX valuation?
Just all of it, yeah. Right, Anthropic, great, amazing companies. But the scale, the size of these companies, I don't know what Anthropic is at, 300 billion, whatever it is. OpenAI is looking to raise at 750. Okay. Somebody's buying it. I'd rather be a seller, but that's not my money. Okay, Marc Rubinstein, for people that want to follow your work like I do, I am such a huge fan of everything that you put out. How do they reach you? Where do they find you?
On Substack, netinterest.co.
Okay.
Nice place.
All right, Marc, you're the best. Really appreciate your time.
Cool. Thanks, Mike.